Mark Twain, an American writer, humorist, and entrepreneur, once famously said, "It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so." Having worked for banks for over 10 years, I've come face to face with many clients that believe in myths that, although they seem plausible and intuitive, in reality just ain't so. I've seen firsthand how much money investors lose by not only believing but also basing their investment decisions on these myths. So I decided to make a series of videos that reveals these common misconceptions and hopefully helps investors avoid the pitfalls. This is the first video in the series. We're going to be talking about active investment management. I hope you enjoyed this video. Please don't forget to like, comment, and subscribe. The first misconception that a lot of clients have and rarely doubt is that active investment management actually adds value. Let me explain what I mean by this. Active investment management basically boils down to trying to beat the market, where the market is some broad-based index reflecting a list of stocks that are available for a portfolio manager to choose from to buy for his portfolio. For example, the S&P 500 is a list of 500 large U.S. publicly traded companies that many U.S. equity investment managers choose stocks from for their portfolios. The idea is that these educated, experienced, professional investment managers, having done their due diligence and research, can identify the best stocks on the list, buy those stocks, leaving behind the bad stocks, and therefore have a total return on their portfolio that is higher than that of the broader index, in this case, the S&P 500. If after fees and expenses, their investment returns are higher than the index, the investment manager earns the bragging rights of saying that he beat the index. Or in other words, added value for investors in the portfolio. All sounds well and good so far, makes a lot of sense. However, when we look closely at the historical records of active investment managers, we see that very few of them can consistently beat a meaningful benchmark over the long term. One notable exception to this is Warren Buffett. However, the vast majority of others who try not only fail, but fail miserably. The numbers are stunningly pathetic. Over 90% of active investment managers underperform the market in the long term. So if you think about it, only 10% of the industry delivers on the promise of adding value for their clients. And they get away with this time and time again because very few people ask the right questions at the bank. And the bank ends up getting away with selling them actively managed garbage, which everyone sure works, but only works 10% of the time. Rather than me boring you with statistics and diving into the technical nuances of the active versus passive investment management debate, which I'm sure will last forever, I want to share with you a very simple model. This model will illustrate why active investment managers consistently fail to beat the benchmark in the long run. You will find this a very useful model to keep in mind when making any investment decision. And the most beautiful thing about this model is how simple and elegant it is. You don't need any investment knowledge or a calculator. So this is totally beginner friendly. So let's imagine a hypothetical economy. The economy has 8 businesses. It has a stock market where shares of all of these 8 businesses are traded. And the economy is tracked by a broad market-weighted index. Let's call it the S&P 8. As time goes on and businesses prosper, every year the stock market will generate a return, or maybe sometimes a loss. This return or loss will be tracked by the S&P 8 index, giving us a measure of what the broader market returned, or in other words, telling us what the free lunch in the market was for that year. Now let's assume that the investors in our imaginary economy are divided into 2 equal groups. Passive investors, those that just buy the S&P 8 ETF, hold it, accept the market return, and don't bother trying to beat the market. And active investors, actively picking stocks in order to beat the broader market, or the S&P 8. So let's see what happens in any given year when, let's say, the market grew by 15%. The passive investors will obviously earn 15% on their portfolio as a group. From this we can deduce that the active investors, as a group, will also average out to 15% return. After all, everything has to add up. On an individual level, of course, portfolios of active managers will all be different, with some of them being able to beat the market, the winners, and some of them getting beat by the market, the losers. Now, a regular person would naturally expect for there to be some consistency amongst winners and losers year over year. After all, we see a similar pattern in other fields, like sports, for example. A champion from last year is more likely to be a strong contender for the title this year. But it just ain't so in the investment game. A winner from one year may very well have epic losses the next year and be wrapping up his fund. This seems almost counterintuitive to a lot of people. But unfortunately, there are decades of studies and research to support that professional investment managers are actually pretty bad stock pickers. Oddly enough, when looking at the performance of active investment managers over the long term, their performance seems to be random, as if having more to do with luck than with skill. So realistically, the chances of you as an investor of picking a winning active investment manager are about the same as you picking winning stocks from a list. Because essentially you're back to the original problem. You're trying to pick winners from a group. It's just that in the first example you're picking individual stocks, and in the second example you're picking groups of stocks. But the problem remains the same. If you don't have a predictable way of identifying the winners, you're better off hedging your bets and buying them all. So after 10 years or so, investors with actively managed portfolios can hope to, at best, average out to the broader market return over that time, just with a lot more thrills and excitement of beating the market some years and getting beat by the market other years. Basically, we're looking at a zero-sum game. For every winner, there's an equal loser. And since the distribution of winners and losers seems to be random, over time things will revert to the mean. Passive investors will just take the mean to begin with, the free lunch, as is, without ever trying to outsmart anybody or try to beat the market. The thing is, they never underperform it either. So this all doesn't look too bad for active investment managers up until we introduce our final layer to our little model here. The final layer is something that puts a big smile on bankers' faces around the world. And ultimately, it is the Achilles heel of active investment management for investors. I am, of course, talking about fees. Active investment management eats up enormous amounts of resources. The active means spending more money on trading, research, and generally hiring more staff to run the operation, as opposed to a passive portfolio that simply tracks a broad list of stocks, making it a very simple and cost-effective strategy to follow. Basically, just check that your portfolio matches the list every quarter, and that's about it. For this reason, active investment management fees can cost the investor 10, 20, or even 30 times more than what they would have paid for a comparable passive investment product. And since we already see that active investment management doesn't necessarily get you ahead in the long run, add to that the additional hurdle of the high management fee, which decreases the return for the investor, we can begin to see why you are very, very, very unlikely to get ahead with an active investment manager in the long run. Many investors don't pay enough attention to fees because they seem so insignificant and small, only 1 or 2%. But notice that in the long run, the passive investor is not ahead because of some stellar stock picks, because he's working for the biggest or most reputable bank, or because he got in on the ground floor of some IPO. The passive investor is ahead simply because every year they are saving enormous amounts of money on fees, keeping that money in their account, continuing to work for them year over year. The high management fees of active investment management make it next to impossible for them to genuinely add value to a client over the long term. This is simply because the manager's investment return is constantly decreased by the fees that they charge. So now every year they have to go out and do the impossible, which is beat the market, just in order to make the investor whole or break even. This sets the bar so unrealistically high that we really should not be surprised that the majority of investment managers fail to add value to their clients after fees and expenses. But as long as retail clients keep paying bankers these fees, believing that they're actually adding value to their portfolios, why would bankers stop trying to beat the index even after many failed attempts? If you don't beat the index, you still get paid a handsome management fee. And if you do beat the index, then you look like a rock star and you get paid even more. As a banker, you can't lose, so why would they stop? So what should Mr. and Mrs. General Public do to avoid getting suckered into paying a large management fee to somebody to consistently underperform the market for you? Don't be the guy that's thrilled to get an 18% return on your actively managed portfolio simply because you're not aware that the broader market returned 30% in that year. So your investment manager basically lost you 12% that year and charged you a fee for doing so. It's nothing to get excited about. Next time the bank pitches you an investment, chances are it will be an actively managed product. Take the time to review the performance and compare the performance to a suitable benchmark. Don't just look at the absolute return. It went up, good. It went down, bad. Many investors looking for moderate risk choose to put their money in American businesses. For those investors, one benchmark they could follow is the S&P 500 index. And if your fund is underperforming the S&P 500 index, it's time to ask some serious questions. Don't forget about passive investment alternatives. They're not advertised by the bank because selling them doesn't make the bank as much money. But they do exist, are readily available, and investors could benefit a lot from using these products. For example, Mr. and Mrs. Retail Client can easily buy into the whole S&P 500 index by purchasing the SPDR S&P 500 ETF. The ETF has a management fee of 0.095%. Now compare this to the Goldman Sachs Blue Chip Fund, a fund that actively tries to pick the best stocks from the broader US market. This managed solution has fees totaling 4.26%. That's over 40 times more than the ETF. Take a look if paying that fee was worth it for investors, and see if Goldman Sachs, arguably one of the most renowned banks around the world, can pick the best stocks from a list of 500. The devil's in the detail, as the saying goes, and while we would expect that active investment managers generally add value for their investors, this is just not so. So be extremely careful and do your due diligence if you do decide to invest in an actively managed strategy. Most retail investors would be far better off following a passive strategy. It's simpler, more cost efficient, and in the long run has shown to deliver better results for the investor, simply because there are less investment decisions to make, so less chance of the investor making the wrong decisions. Active investment management consistently adds value to banks because it provides a consistent, juicy revenue stream of management fees in bull and bear markets regardless of investment manager performance. I hope this video helps you make sure that your money is working for you, not for the banks, and that you get to your financial goals, or ultimately financial independence, quicker. If you have questions, don't hesitate to leave a comment, and share this video with people you care about who want to become better investors and want to make sure that their money is working for them and not for the banks. Thank you for watching, and please don't forget to like and subscribe. Till next time.